What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I'm feeling like 100 grand.
You are listening to Inspired Insider with your host, Dr. Jeremy Wise.
Dr. Jeremy Weiss here, founder of InspiredInsider.com, where I talk with inspirational entrepreneurs and leaders. Today is no different. I have Yoav Sebba of XT High Tech. And before I formally introduce you, Yoav, I always like to point out other episodes people should check out of the podcast. And since this is part of the Top Israeli Business Leader series, there's some past episodes you should check out. Ronan, CEO and founder of M51 Entrepreneur Labs. He co-hosts the Real Life Superpowers podcast with Noah Eshed, who, big thank you to Noah for introducing today's guest. Thanks, Noah. Really appreciate it. I had the founder of Full Path, Aaron Horowitz. They have a great podcast led by Alana Shabte called Inside Auto Podcast. I've had Yossi Vardi on and Luis Navone of Mobileye, and he talks about the journey of Mobileye getting acquired by Intel for $15.3 billion. It's kind of a crazy story. I'm sure you've heard it many times, Yoav. And Mor Levy, co-founder of Cymbio, who actually I had on many years ago, and XT High Tech actually invested in Cymbio. So check that one out and many, many more at InspiredInsider.com. And this episode is brought to you by Rise 25. Rise 25, we help businesses give to and connect to their Dream 100 relationships. And how do we do that? We actually help you run your podcast. We are a company that does accountability, strategy, and full execution and production of a podcast. Essentially, we're an easy button. So the number one thing in my life, Yoav, is relationships. I'm always looking at ways to give to my best relationships. And I found no better way to do that than the profile of the people and companies I most admire and share with the world what they're working on. So if you've thought about podcasting, you should. If you have questions, go to rise25.com. I also want to give a big thank you to Spaces. Right now, I was telling Yoav that I'm in Scottsdale, Arizona. I'm not typically here. I needed a great place to work with fast Wi-Fi and in-house services. And I reached out to them, and they have an amazing space here, private offices, co-working spaces, meeting rooms. They have 482 locations around the globe. A big shout out to Erica for being so accommodating. Spacesworks.com. You can learn more. Without further ado, I'm excited to introduce Yoav Sebba. He's managing director of XT High Tech, which is the venture capital arm of the global industrial XT group. They've invested to date in more than 80 startups. 30 of the startups were acquired or went public, and 15 plus of them are on their way. Yoav is an active investor, has experienced 3 bubbles, 3 downturns. And I love some of your sayings, Yoav, when I was reading and researching you. It's like, you try and only make new mistakes. Okay. So we may talk about what are some of the old mistakes that you're not going to make again. And you also believe that one good dollar from a customer is better than $100 from an investor. So we'll talk more about that, but thanks for joining me.
Thank you very much for having me, Jeremy. It's okay. I would like to start with a quote of someone which I'm sure that most of us are very much familiar with, which is Wayne Gretzky. And of course, everybody questions that they ask. Do you remember the famous quote of Wayne Gretzky that I skate to where the puck is? And then, of course, he didn't say that. He said that I skate to where the puck is going to be. And this is the essence of what I'm trying to do for more than 20 years, is to try to assess where the path is. This is the essence of high-tech investing. So to know where the path is going to be, and this is why it's called the venture capital business is a risky business. My investments are not liquid; they are very high risk. But nevertheless, we here operate quite a profitable business for more than 20 years, mainly leading A rounds in Israeli technological companies. We are, in terms of field, we are diversified. We invest in ag-tech companies, in cyber companies, medical companies, e-commerce companies. The main denominator is strong CEOs who would like to make a difference in the world.
What's your risk tolerance? Sometimes people say, the people in some of the riskiest businesses are the least are risk averse. What's your risk tolerance?
Very good question. We are a corporate venture capital fund. So we are a part from a much larger group, which has activities in shipping, energy, chemicals, real estate around the world. You can see the vessel behind me. It's also one of the vessels of our group. And when we bought this vessel, we bought it when we know that we would have the financing from the banks to do that. We know that we have a customer for a lot of years to use it. So you can say that in terms of our DNA, we are conservative. Having said that, in the high-tech business, it's something which is completely different. When being asked by the group here, what would be the exit of next year? How much would you invest next year? So my question to both of these questions, I have no idea. So it's a risky business, but we invest in a portfolio. And as you mentioned, from 80 investments, we had more than 25 exits today. And we hope that from the current portfolio of 20 companies, at least 10 or 15 will provide a considerable exit. We do around 4 or 5 new investments a year. We, of course, invest in our own portfolio, which is currently relatively well funded. But it's a risky business, and it also has to do a lot with luck. I'm talking here from Israel. The founding person of Israel was called David Ben-Gurion. And he said that in order to be realistic in Israel, you must believe in luck. So, but we define luck, and here is another quote from someone else, that we define luck as opportunity which meets readiness. So we try to be ready as much as we can, and we do everything we can in order to reduce risk. We go to experienced CEOs. It's like each company which is coming, it's like we're doing it like a blood test. With the management, the technology, the patent, the market, the competition, the unfair advantage. We look at like maybe hundreds of parameters, and still we manage to make, as you said earlier, mistakes. So we're just trying to avoid the mistakes we did in the past. But sometimes we manage to do those as well.
Yoav, what do you look for in companies?
First of all, strong CEO. And in this respect, and we look, of course, for companies which could yield for us, let's say, at least $100 million in terms of an exit. So
how much?
For us, let's say around $100 million. So it means that the exit would need to be at $500 million at the potential. Would need to be. Of course, we have experienced exit also, which were significantly lower, and some, of course, were higher. But this is if the company would not have the potential to provide us this, let's say, 10x multiple, this was something that would be very hard to pass through our committee. So we try to see almost everything that we have in the market. We have in Israel around 10,000 startups. I think that we see around 1,000 a year. From these 10,000, and in terms of CEOs, I think we discussed it in our previous conversation. We try to assess who is the best CEO, which is the most critical thing in each company. And we looked at our own experience, and also we try to learn from experience of others about first-time CEO versus, let's say, a serial entrepreneur, someone who was very successful CEO in the past. And I must admit that I was even surprised, because we're always looking for the experienced CEO, not the first-time CEO, but we saw no correlation. And maybe part of
no
that,
correlation at all.
no correlation. Like 50% of the very good exit was first-time CEOs, and 50% was is very experienced one. We always strive to have someone not to, let's say, to learn the business on our beard, let's say, but we found that because in this business, which is a changing business, sometimes need someone to take a very tough decision, and as you said, also risky decision. So, and the experienced CEO can sometimes be a bit reluctant from taking these risks. A lot of time with he has all the good reasons to do that, but in order to succeed and succeed big time, a lot of you need to take these risks.
What are some other surprises? So that is surprising, right? You'd think you put up a first-time CEO versus experienced CEO, and the experienced CEO is going to win. Not the case. What are some other surprises that you found throughout the years that you know, kind of has shown up?
I was a bit surprised, let's say, from what the boss always said, like pick the low-hanging fruit. So it sounds very good, but in reality, I must tell you that at least for us, like it was like 20 out of 20 or 25 out of 25, that it appears to be that if you would like to go for the big fruits are not hanging low, and if you would like to go for them, go for them. Don't go for the low-hanging fruit. If you go for the low-hanging fruit, this is all you will get. And you need to be focused. You need always to go to where you aim and not to look for all kind of what perceived to be shortcuts, but in reality it tends to be way to nowhere. So focus is critical in that respect. We look for focus in terms of industry, look focus in terms of geography. Cymbio, which you mentioned, I think earlier, is a perfect example for that. Focused on US customers, focused on fashion, focused on accessories. Before moving to each to another continent or to another field, they would of course have critical mass in one field and only then move to another. So, and this is we found it also to be critical. Also, what we found, and we quoted, this is let's say this is the first one. This is my quote: that $100 of an investor is $1 of the customer. And I would like the CEOs of the companies and the founders to talk, let's say, with people like me, and as less as they can. So, and this is very. I want them to be focused on customers and not on investors. The one which are, it's very hard to obtain this $1 from a customer, but this dollar is one from which you learn the most. Companies which raise a lot of, and there are CEOs that are amazing with raising funds, and there are CEOs that are very good with customers, and you can imagine who are the most successful ones eventually with the exit, and who are the one we are looking for. So we are not too excited if company is raising a lot of funds. On the contrary, we look at what everybody wanted to be in the last 2 years. Everybody wanted to be unicorns. Unicorns is defined as company which is raised funds, the valuation of north of $1 billion. So for my end, it means that they were unsuccessful in obtaining funds from customers most of the time. It was very easy to come to people like me, but my money is on one side is much simpler to obtain than customers. You will learn nothing from it, but you will gain another partner. Sometimes it's good, sometimes it's bad, you look at it like putting sugar inside coffee. You can put it inside, but it's very hard to put it outside from the coffee. So this is how we look at the partners. So we looked at unicorns most of the time, if the company would be sold, let's say for $200 million, which can be a very good exit, but if the company raised $300 million or $250 million, all the investors will lose money. Most of the common shareholders, of course, will see nothing. So this is to being a unicorn most of the time is something which we do not look at it as something which is positive. Having an ARR of $5 million, $10 million, this for us is much more important. And here, there are a few types of ARR. There is healthy ARR of companies with good DNA, and there is what we say is unhealthy ARR. And if it's okay, I would give an example. So we invested in a fascinating agriculture technology company, agtech company by the name of Phytech, Phytech. I came and the CEO tried to convince me, come meet our customers, and then I was saying, agtech is, farmers are very conservative. There are no big successes in this field. So I don't know how he managed to convince me to go to visit one of his customers. So I found myself in north of Israel. I'm talking now from Tel Aviv. And I found myself in north of Israel at early morning and talking with one of the farmers. And then I told this farmer, now I will take the company is doing, it's like a platform for farmers, which is telling them how much to irrigate, how much to fertilize, handling all the crop protection with all kinds of special sensors and data it receives actually from the plant itself. It's like a doctor which actually touches you and see you, and before you know it, before everybody knows it, tells if what needs to be done, and we see higher yield and much lower cost. But then I was not an investor. I just came to and saw the farmer, and I told him, I came here to take your device. I came here to take your sensor, the one which are the platform. So he immediately stood between me and the devices of the company, like he was afraid that I would take it from him. He told me that, without this, I'm blind. I don't know what's happening in my field. It's like, what can I do now? It's like it took from me the ability to, it took Google from me. And this is my main business. So then I realized that we must invest in this company. So we invested in the company. When we led the round, Syngenta and Mitsui joined us. The later Tencent led the round. Around after that, THL, THL invested, and now we also have a strategic round that will be announced very shortly. But as I said earlier, this is not the main thing. The main thing is that the company is growing organically at least 40-50% year over year each time, with a retention of close to 100. And it's currently focused in California, in apples and almonds and all kinds of crops. But it's now going globally and also with other crops. And it's also, of course, contributing to the world. But from my end, thinking like a capitalist, it might be one of the best agtech investments, at least coming from Israel. And we also have worldwide recognition, mainly from the US.
Yoav, do you always, when you're investing, in this case, you weren't even thinking of investing necessarily, but when you are, do you always like to talk to the customers before investing?
I must. It's critical. Did you meet an entrepreneur that said that told you that my business is sucks, or I have very low potential, or
right? If they're being honest offline, sometimes, but not to the public face, yeah.
So So you must talk because, this learning experience not only allowing me to decide if to invest or not, it also allowed me to understand how much funds to invest and how much the company would need and what valuation to do it. And we are leading around. We are mainly not joining. And it also allowing ourselves as a group and let's say I think that 60-70% of my time is in the board of these portfolio companies, trying to assist them as much as we can, trying to provide value. And it varies, of course, between company and company, and field, and CEO and CEO, and specific situations. And if I'm doing a due diligence, which takes a lot of time and going to evaluation of patents and competition, and especially talking with customers, we can learn almost everything from customers, especially about competition, about budget, about the process, about the installation, about almost of the aspects of the business. So, and this is critical later on. This is not just for deciding to invest, but also how to better work with the companies. And then there are hurdles in the way. There are many hurdles. There is no like slam dunk or something simple. I never witnessed, maybe others, but always it's hard work with a lot of technical thing and boring thing and argument and everything is, but we managed to, at the end, it's critical that we have developed, as you said at the beginning, you are about relationship, also we are about relationship. And I encourage companies which are also evaluating me, because as I told you about the example with the sugar and the coffee, I tell them that they should be very careful about which partner they are putting in. So I encourage everyone to talk with CEOs and entrepreneurs, founders, that we invested in, the one we succeeded and also the one we failed with. So because it's a relationship, and we feel, I must tell you, we not have 100%, but most of the time we feel very good with our portfolio and with the companies we invested in the past. We also try, of course, to have good relationship also with companies we are not investing in. Because in the end, it's all about people, everybody, and we try to avoid from being like or perceived or being like in these days, of course, especially these days, as the one that has the money, and because at the bubble time it was completely different, but now things have changed, and we are not trying to take advantage of it. We are just trying to, of course, to adjust our portfolio and investment to the new situation. And also, as Darwin said, it's not the strong species will survive, it's the one which is most adaptable, which can, of course, adapt itself to the new situation. So we are learning all the time. We are modifying our approach all the time. If you would do this interview with me, let's say 3 years from now, I'm sure it will be completely different. 3 years ago, it was also different. So we try to learn and to of course, take this experience to our investment and to our portfolio as much as we can.
Yeah, I think when you said that, it seems so obvious, but it's not. If someone's considering investing in companies and buying a company, actually just talking to the customers, whether it's a large or small, it's almost the same thing if you're hiring someone, checking references. So thanks for that. When you say it seems so obvious, but it's not something I necessarily would have thought to do every single time. You mentioned some of the criteria for companies, right? So focus is a big one, healthy ARR, healthy DNA, CEO. Where does a company have to be? How much traction do they have to have, by the time they come to you?
So very good question. And then I may a bit contradict myself now, because part of the companies which are coming to us do not have revenues at all. So I cannot talk with their customers. I do not have this ability. I can talk with potential customers, but most of the time it's we invest in B2B companies. I will provide an example. We invested in a company by the name of Epitomee. It's EPITOMEE. Let's say it's adjustable devices. The first product line is a capsule that you swallow together with 2 glasses of water, and then you do not feel hungry for a few hours, and then it self-dissolves. So when we invested in the company, it was just like we did not have any regulatory approvals even, and we had to imagine and we had to talk with a lot of people coming from the industry, talking to the head of Obesity Federation in the US and all others, trying to assess. And this is a very risky investment. But in our balanced portfolio, we do like, let's say, I think 20 or 25% investment, which can be ranked like a very, with a relatively high risk reward ratio. So if you would do this kind of investment, we would like this investment to have a potential of like over $1 billion. So this and Nestle, exactly, this is the one. So Nestle found it out as well and decided to invest in the company. Also, as part of the IPO we did here in Israel with the company, and the company managed to develop, as you can see here on the screen, also a biologic delivery platform, which is currently on a relatively much more earlier stage than the waste management product line, but this is the future we're currently also working on. So we have the first product line with Nestle, the other product line which we are currently looking for is written here for collaborations about drug delivery products. But this is a company we did not have the ability, of course, to talk with customers because there was no even regulatory approval in order to allow us to even test it. So, but now we have a regulatory approval in Europe, in Israel, and we are currently working hard in order to obtain the regulatory approval also in the US.
So why did you invest in them despite no customers, and what did you see in them?
We talked with the company, did a small trial. We looked at all the reactions from this trial. We looked at the science. It took us a few months in order to evaluate all the ingredients. We took a lot of industry experts in various fields. We evaluated here, patents are critical. But more formal, but we had here an amazing chairman, active chairman and founder. This is Dr. Shimon Eckhout, and a very good, an excellent CEO, Dr. Dana Shimshoni. This is a fascinating company. Lots of interesting things to come, hopefully, from this company. But and here you look, of course, at the passion of the CEO, which we find is critical. That the company would be even, I don't know, they can, of course, after a few exits, but they must be very hungry and like it's their first day at work.
So it ranges from no customers. So what's another example of someone coming to you, like in the type of traction they have?
So another example I can provide is Cymbio. Cymbio is, you can imagine it like a Google Translate between brands and retailers. Just announced today that they are starting a very interesting trial, by the way, with TikTok. They are like the technological bridge between brands who would like to sell at various marketplaces and various retailers. Like New Balance currently is a brand that is working with us, and Camper also. On the other side, we connect them to Macy's and Nordstrom, and potentially now also TikTok, Amazon, etc. We allow them seamless integration and also the ability to do drop shopping. Exactly. This is one of the founders of the company, Mo Lavi. And when we invested in this company, the traction was close to minimal. But despite the fact that it was close to minimal, when I first met the company, I said, no, there must be like hundreds of these companies. So, and also these the two founders, Mo Lavi and Roy Avido, they also know if you talk to them today, they will tell you that they thought that it's a waste of time meeting me, and that no way I would invest in them, because they thought this is what I thought also after the first meeting. But then I took 2 weeks.
Why did they say that?
Because I was not, because I was thinking in my head, it's a very interesting idea what they're doing, but I'm sure that there are hundreds of companies doing exactly the same thing. So I went back to office after meeting them and started to look for competition. And I looked and I looked and I looked. And after 2 weeks that I failed to find any like real direct competition, I saw what they are really doing and how much hard work for many years with specific customer it takes them in order to develop this platform. So then I came and then we led their seed round when there was only small traction, but then we led the A round. B and C round were also led also by after that by Vertex and Corner, and now we had we are humbled that PayPal decided to join the last round and also to invest in the company. So and we are the largest shareholder, and we are in a very very good relationship with the team. It's a ride we enjoy very much, and it has its ups and downs, but it looks like this one, so on the right direction. So here even a small traction is something that it might be sufficient for us, but we need to see this part. This part is critical, and we need to see this. And here, what we found out is that a brand like New Balance might be connect Nordstrom, and Nordstrom Camper, and then Camper Macy's, and it's like we have like a domino effect, like a semi-viral effect, and we found that. And of course, in real life, it's a bit more challenging, but we saw that the integration is something which is relatively easy.
So in this case, it's almost like you went back, you're like, well, you had some preconceived notions. And when you actually dug in and did some research, you found they actually did have proprietary platform, and there wasn't as much competition as you thought. So we have a case where there's no traction yet, it's really startup phase, and then some traction. What's an example of one where they actually had traction, or you saw there was product market fit?
I can tell you that an example, a company by the name of Next9. This company started as a support company, and it sold, but it was not too exciting. And then it found its product market fit in the cyber business, in the industrial cyber business. It was providing support for all kinds of devices at industrial facilities, and then it came actually from the customers that they asked for how to control all the access, and how they know it, how they can prevent access which is not authorized. So then Next9 became a industrial cyber company, and then it found its product market fit, and we were all very excited. However, and this has to do mainly with us as a board and shareholder, and this is about learning, let's say, from mistakes of the past. We as a board were not functioning excellent, and the company relied on us saying the company was sure that okay, because we have this product market fit, and we would keep on supporting the company. But we as a board and the shareholder, each one had its own view of the company, and the company found itself in a very delicate situation in which it did not have the support of its board and shareholder. And actually, we gave all the employees, we were about to close the company. Despite the fact that it has a great product market fit and it found itself, and there was a lot of promise, the company was almost sure that we would save it like the last resort. But again, the board was not functioning almost at all. And the company, as a last resort, had to obtain the missing, the required funds from one of its customers. And this was, from then on, it's like the train coming back on track. And then later, fast forward, like 1.5 years later, we sold it for around 3x of our investment, but the company was very, very, very close to bankruptcy. We even filed the papers, but we even didn't manage to agree on the proper wording for this, because the company had to say, okay, board, okay, dear shareholder, and then go with its customers and go with the employees which believe in the company. And then it was a good example. I do not recommend everybody to go over what we went to these days. It was a lot of stress, a lot of tense. But this is, and even going back, you can never know what's happening. But if you would, let's say, the shareholders and board decide to invest additional fund in the company, I don't know if the company would succeed and would be able to obtain, because the company, like creating the company, and the best focus, when you are hungry, you have a very good focus. When we had two portfolio companies of ours, which obtained funds in a process of 2 weeks, and both of these companies failed because too much money, as I told you at the beginning, also in relation to unicorn, can lead to developing products the customers don't really need, operating in geographies which will not have a critical mass, and then they develop higher salaries, too many employees. Even now, they were recruited people, and now when we do not call it a recession, more like normalization, we see that now many times a team of 3 people can do much better than a team of 5.
What's interesting, do you find that to be common at all? Where that makes sense, where you see a larger customer of a company that wants to invest or that does invest because they have an invested interest in making sure that company stays alive? Or is that not that common?
This is where you are tested, let's say. This is why it's critical, and we saw a lot of, during the bubble, a lot of rounds which are being closed in a matter of days, and the investors do not know what they invested in. And then the next round is coming. And there's a need to decide whether to invest additional funds, both valuation to support the company, not to support. These are the most, let's say, critical and tough decisions. Knowing when to, and I call we call it on the one side, we need to know when to let go. But I believe in most of, in perseverance, keep on going to believe in the company is also critical. As you saw in the example of Next9 earlier, you need to be focused, you need to believe, you need to keep on going despite all the challenges around. But as hard as it can. You need to have myself as investor and have the right portfolio. I need also to know where to put my focus on and where to put our investments. And this is critical. We try to be. We have most of the companies holdings. We try to invest in fewer companies, but the one in which we invest in, we have around 20% plus minus. So not like 5%, 3%, or not 40%, but meaningful and also very critical. But there is a famous also, I like quotes, quote like, men plans and God laughs.
Say again?
Men plans and God laughs.
Men plans and then God laughs. I guess, yeah.
But sometimes, if the man is not planning, God is not laughing. So it's also the vice versa. But we try to plan as much as we can, but it's a risky business. And we need to rely on the good CEOs and assist them where we can.
Yeah, I don't know. I think the quote is there's a quote that's attributable to Mike Tyson. I don't know if he's the one who originated it, but everyone has a plan until they get punched in the face. I don't know if that's Mike Tyson, but
also, we had a lot of wars here in Israel, and we also say that all the plans are okay till the first bullet is being shot, and then the most and then if you would like a symptom of a company which is going in a bad direction, you will see that the board is saying, okay, let's wait for next quarter, and then we'll take a decision. Then we will be smarter. I'm sure that you heard that many times. Let's wait for next quarter, we'll see the result, then we will be smarter. So it means that if you will be smarter, it means that now you are stupid. You are not so smart. And but next quarter, I'm sure that you will be also poor because you will have less 1 quarter of burn rate. So, and this is the inability. This is like almost all the time, it's inability to take decisions and to understand what's happening. Let's say a company, and also I'm stealing here from someone else, but so let's say a company is relying on how much is the cost of, let's say, of a message. Let's say the cost of a message is 5 cents. And all the business model is relying on the cost of, and you see that in this market, it's 5 cents a month. Now it's 6 months, 7, 8 months. And suddenly 1 month is coming and these companies are relying on how much cents per message they are receiving. And suddenly they see in the market that from 8 cents, now it's instead of coming to 9, it's 8.5. So 90% of the, let's say 50% would not even not notice it. The one who would notice it, most of them would say, okay, I see that there is a small decline in the growth, but let's wait and see. Let's try to analyze what's the cost. Only very select group of CEOs, and this is the CEOs we try to invest in, would know exactly what happened and would act immediately. And this is critical. This is what you said. So in terms of, we try to invest in these people who are fluent in their industry and know the business of their customers. So this is the most critical thing for us, to know that they are in the detail. If, I asked 2 hours earlier today, a CEO about one of his projections for next year, and he said, I will need to look at the Excel. So I'm not saying like it's that we would definitely not invest, but it's certainly not a very good point in his favor. They have to be in the details. They have to be bottom up. Of course, not to lose the big picture and have the strategy and the macro view, which is critical, but we believe in the details. And here also from us, as a group of investors, we are digging in, we are looking at the patent, we're looking at the Excel, we cannot doing it like everything on the macro level.
Yoav, let's talk about Sofwave for a second. And in the beginning, what you saw, and then take me through a little bit of the timeline. Because they eventually got, did they go public or got acquired?
Go public in Israel and progressing very well. So I told you earlier that we invested in Epitomee, which was founded by its active chairman, Dr. Shimon Eckhouse. And Dr. Eckhouse saw us how we operate as partners. And then, like a few executives in the company, and few months later, he also said, okay, you are a good partner, and now I would reveal to you, let's say, I don't know if to say the crown jewels, but I would reveal to you my, let's say, main company, which I'm currently working on, which is Sofwave, which he also founded, and he's also an active chairman in. And Sofwave was a relatively easy decision, but also on the other side hard, because Dr. Shimon Eckhouse is one of the pioneers of energy-based devices in order to remove wrinkles and hair and from all kinds of aesthetic treatments. He did it by inventing Luminis, which was based in, here you can see the result. If you can pause here for a second. So he did it by inventing Luminis, like 20 years ago, more than 20 years ago, and it was based on laser. After that, we did it with a company by the name of Cineron, which did it by using RF. And now he came to us with Sofwave, which is doing it using ultrasound. So we decided how can we check the company? How can we evaluate the someone which is number one in the world in what he's doing? So we looked all around the world, and we found in Boston, and we flew him here to Israel, someone who used to work for him. And after evaluation of a few months, also evaluating the patents and everything, because the company did not have any customers, zero sales, only working prototype, which did the trial, hoping to gain FDA approval. But we trusted Shimon, and it's a wonderful partnership that we have with him. We invested in the company. Later, the company received its FDA.
From an outside perspective, Yoav, it looks so risky. You're right, because it's not proven out yet, right?
But here you can take risk of someone who did it, and this exact, he called me and tell me we're supposed to have, when we invested, we're supposed to receive the FDA, let's say in April, and then during March, he's calling me and said we received the FDA. So it's like he's the best in the world in exactly what he's doing. He did it, as I told you, with lasers, with RF, radio frequency, and now with ultrasound. We took the best experts in order to evaluate the technology and IP and market, everything, and we didn't spare, and still it's very risky. But the company came from, and again, it was a prototype when we invested in, and now we announced that last year we sold for $36 million. I think Q4 was around $30 million, and this is still only without Brazil, Taiwan, Mexico, which we just received the approval, also without China, in which we are hoping to get the approval maybe late this year or early next one. And this is without, we just announced also that we received an approval to do cellulite treatments as well, not just removal of wrinkles. And you can see that is the best non-invasive treatment there is, at least what we think that what our we see that the ROI for our doctors, for dermatologists and plastic surgeons, which are buying the system, is less than half a year, less than 6 months. And they are using it much more than we anticipated when we invested in the company. It's a risk, but here I can take a risk of someone who did it a few times very successfully. And I'm also, after that, I evaluated, of course, everything, the technology and the patent and everything. We took a lot of experts in order to evaluate the company. By the way, in Cymbio, we didn't almost talk it. We didn't take any expert at all. It was like more like us talking with the founders and trying to learn about the company. Sometimes we take external experts in order to assist us, in order to evaluate the company. And sometimes we're doing from our own internal resources. Because we are a larger group, we have offices, of course, in Singapore, London, Amsterdam, here in Haifa, several, and we try to leverage the resources of our group, which I told you is diversified.
What was the timeline like, from when you first talked to and considered Sofwave to actually making an investment?
I think it's around 4 months.
Is that
also Epitomee? I saw it, and then I told them, when you would have an indication from the FDA that of this route of going, so then we will start the evaluation. Because as I told you, we cannot like to make a new mistake. We'd like to make only new mistakes. In one of the companies in which we invested in the past, it looked like it was a delay of almost 2 to 3 years after the FDA provided its guidance, how exactly they would like us to do the clinical trial. So this is something which we learned, and I'm sure that we'll have many mistakes in the future. But as I told you, we try to avoid making the ones we did in the past.
How do you create a valuation for that company, since they don't have, they're new, they don't have the FDA clearance yet, they don't have customers yet? How do you create a valuation? And then, like you said before, you never talk to a founder who says, I'm not going to be the best thing since sliced bread. This is going to go, everywhere. We're going to be huge. How do you come up with a valuation?
We look at it's a good deal. It's a good deal for both sides. We don't want to dilute the founders and the CEO and the existing shareholders too much, of course. On one side, on the other side, of course, you would like to have as much as you can. But then, if you are holding a majority shareholder in the company, then there will come another round. All the eyes will be only on you. So you need the company to have a few pillars, not just one. But we try to do like in the eyes of something that would provide us, and we do a lot of stress scenarios around between, let's say, 5 to 10x on our investment. Hopefully, potentially 10x. And we see it happening, and sometimes not. But and then most of the time, the A round take, I don't know, between 15 to 40, even sometimes even 40% of the company. So we can say that A round can take maybe 20 to 25% of a company. So you can, we also, it's very important for us that the company would not need hundreds of $millions after us. The company hopefully would need maybe additional 2 rounds in order to have to reach significant. Our fund would enable it to reach significant milestones and to have a valuation which is much higher, and then of course to reach an exit within least maybe 2 rounds or maybe 3 rounds only after us, and not more than that, and not more than, as I told you, not more than $100 million of investment going in.
First of all, thank you. I have one last question. And thanks for sharing your expertise and knowledge. I know it's late there, Israel time. And my last question is about your team and some of the people on your team and how you actually were able to put together this team at XT High Tech. And by the way, for some of these, if you're listening to the audio on whatever platform you're listening to, there is a video piece where we'll be kind of screen sharing some of the companies. And right here, if you are watching the video part, you can see I'm at xthightech.com. I'm on the company page. Again, more than 20 years of backing Israeli startups. And you have some of the team members, right? And there you are. So talk about the team.
On the top line, this is our group principal, representing the Angel family and the Offer family, which are on top of all this shipping and chemicals and energy and industrial group, the global group. And on the second line, and they are challenging us all the time. And we are operating in an evergreen corporate venture fund. So they know exactly how much they invested, and they know exactly how much they received back from exits. So it's not like we cannot tell stories to these Angel and Offer families. They know it's I don't need to tell stories about IRR, etc. They know exactly how much money is coming in, how much money is coming out. And so actually we are living in the kitchen in that respect. And they are challenging us from time to time. This is an amazing experience for us to have these people, which are among the, in terms of worldwide business managers, to work very closely with us. And they are very into details to what we are doing here at the high-tech investment field. The other line here, and here we can see, I would like to focus on Asif. Asif is the managing partner, the managing director here with me. He was the CEO of a very successful technological incubator here in Israel. It was also part of our group, in which led for very successful companies such as Checkmark and Zymotech, and a lot of companies going for NASDAQ and others. And so my partner Asif and also has operational experience as a CEO and also the founder of companies. So I'm working with Asif for more than 20 years, and we have a slightly different approach to companies. If you would interview him, we would hear not completely different, but you will hear a completely different angle. And this is very important for us because in discussions we have are very fruitful and open. And if we agree on a company, this is something which is it might be there. I think that most of the time it would become a success because we look at things a bit differently. So and this is in our discussion we joined our group after we had a few very good realizations, very good exits, some via IPOs and some M&A. So we extended the group, especially now with the new atmosphere. And we took from the industry, here, Tom Lavie, Sivan Abrahami, and also we're looking at public companies as well. And as I told you about CEOs, whether first-time CEOs, experienced CEOs, it's not exactly what the person has in his CV, but it's his passion, and they are all of them have one thing in common, which is the passion to succeed. They know how they love to learn. All of them are hard working and into the details. Here on the bottom, by the way, you can see Eyal and Guy, which are in Lital, which is because we're coming from a big group, and these are part of the resources, the very good resources that we receive from the group. As an example, Guy was the CEO of a multi-billion-dollar company from the shipping business, and we are fortunate to have him assisting part of our portfolio companies, especially, of course, on the financial aspect. Also, I can say the same thing about Eyal, which are highly overqualified for, of course, the task that we have here with the venture capital activity.
Amazing. Yoav, I want to be the first one to thank you. Thank you so much for sharing your expertise, joining me, and we check out other episodes of the podcast, everyone, and we'll see you next time. Thanks.
Thank you very much. I must tell you that before coming to this interview, I watched a few of the episodes, and I learned from them. They are highly interesting. And thank you very much, Dr. White, for having me.
Thank you. Thanks, everyone.
What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sailing right now. I'm feeling like $100 grand.